Hello traders, Gary Wagner here. It is 10:20 in Honolulu, 3:20 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 24th day of February, 2023, and this is the Weekend Review. The big news today is the PCE report, which shows that inflation is sticky and remains over 5%. In fact, the cost of U.S. goods and services jumped by 0.6% in January, taking year over year to 5.382%. That is the largest increase since last summer.
Yeah, this is bad news. It's bad news. And it's bad news across the board. It's bad for the economy. It's bad for livelihoods. It's bad for bonds. It's bad for stocks. It is just bad news. I think right now they're going to have a very serious discussion as to not only should they have done 50 last time, which they should they do 50 next? And it's a really tough discussion. Minutes were not consistent with the message of the press release. I think people are already doubting. Look at what's been happening to every inflation indicator. It is heading now the wrong way. People in the street are starting to doubt whether the Fed can deliver the 2%.
And it is that doubt that is pressuring U.S. equities lower. All of the major indices down today. About the only thing we are seeing higher today is the energy complex, bonds, and the dollar. In terms of gold, it is currently down $8.60 or 0.47% at $1,818. Silver is down by 2.6%, with the most active March contract currently fixed at $20.74. And the dollar is up 0.62%, with the dollar index fixed at 105.19. In terms of our technical studies, I first want to look at silver futures. This is currently basis the most active March contract. We hit a high just shy of $25 through the end of last year into January and February. But what is most noteworthy is typically silver's decline when compared to a correction or decline in gold in terms of the percentage decline is greater. And we are certainly seeing that currently with silver trading from $24.78 to today's close at $20.81. We have broken through the 50% retracement level, and in terms of critical support, that would come in silver at $20.22. Today's PCE report was an absolute game changer. It indicates that even with the aggressive measures taken by the Federal Reserve, inflation remains persistent or sticky, which will cause the Fed to act in a more hawkish manner. We're looking at a monthly chart, and although the month is not over, you can see that we have easily gone below the opening price in January. And in terms of a candlestick pattern, it is an engulfing bearish. I have to say a variation because the pure pattern would indicate a open in February above the close of January. You can see there's a little bit of a gap right there. Nonetheless, if we see a further decline as we go into next month and gold futures break below $1,800 to $1,790, it could be technical proof that we are in a pivot or key reversal from bullish to bearish rather than a correction. This next chart will clear up or illustrate the point that I just made, and that is that from March of last year down to October, we had a multi-month correction characterized by lower highs as well as lower lows. After the triple bottom on November the 3rd, we went into a bull market, which is characterized by a series of higher highs and higher lows, and that occurred up till this recent high at $1,974 and the sell-off that we are currently in. As long as this correction concludes at approximately 1800, the next low would in fact be a higher low than the previous low, and that on a technical basis is the definition of a proper correction within a bull market. That is why I maintain a line in the sand at approximately $1,800 per ounce. This has been Gary Wagner, wishing you as always good trading. We will talk to you after the weekend. Bye-bye.